Hello. In this video, I'm going to talk to you about using a discounted earnings approach to estimating the value of equity for a firm. We've already talked about a discounted cash flow approach. We've also talked about a dividend discount approach. This is sort of a compromise between those, so just sort of bear with me. If you'll recall, again, the formula for the discounted cash flow approach to equity, if we basically reduce the cash flows to a growing perpetuity, are basically the cash flows at year one divided by the required return on equity minus your growth rate, so your assumed growth rate in cash flows. Under the discounted cash flow model, the cash flows are the free cash flows to equity at the end of year one. And again, if you'll look at that video, you'll find out what free cash flows to equity are, and there is a separate video where I talk to you about how to estimate those. Under the discounted earnings approach, we take a slightly different approach. First of all, we use earnings per share as cash flows instead of free cash flow to equity. There are two consequences to this. One is when we say earnings, we're talking about just net income. We're not talking about something that you have to derive by making a bunch of adjustments. And two, it's per share, and so it's divided by the number of shares outstanding. That division doesn't really affect anything. You could always just use the market capitalization of the firm and the earnings per share. But instead, we're going to use the stock price of Disney and the earnings per share. All right, so when we do that for Disney, we know that the stock price is $108. I've shown you where to find that before. The cash flow, the earnings per share, is $1.56. Let me show you real quick where I get that. When I go over to Yahoo again and look up Disney, I can go look into the analyst information, and you'll see earnings per share trends. So it's not $1.56, I apologize, it's $6.65. I haven't changed that. And you see the current earnings per share estimate was $5.93. For next year it's $6.65. So that's what I'll put in there, $6.65. Hopefully I made that correction in my calculations. So when I go over to my spreadsheet, I just made a copy of the dividend discount sheet, and we've sort of adjusted some of this stuff. So $108 share price, no problem. EPS trailing was the $5.93. EPS for next year, so forward looking, earnings per share, $6.65. All those things all look right. Again, this is just taking this divided by this minus 1. So it implies that the earnings for next year are going to grow at about 12%. We don't want to use that 12% here because that's only a 1-year growth rate. We want to figure out what's implied by the stock price. So again, we've plugged in the 5% as just a plug for growth because we're going to solve for that. You've got these different amounts that are just values read from above. The formula, once again, is the stock price, so VE, divided by the return minus the growth rate. And so, as before, we're simply going to use the what-if analysis goal seek in Excel. We're going to set the difference between the 108 that we know the current price is and the 503 price that's being estimated based on a 5% growth rate. That's a $395 difference. We want it to be 0, so goal seek, we're going to take that value, set it to 0 by changing this growth rate. And when we do that, we get a growth rate of 16%, or 0.16%, sorry. So you see that there. I don't know if you recall, but with the discounted cash flow, the growth rate was about 0.18%. So these two are giving very similar results, but you didn't have to go through that whole process of calculating out free cash flows. So sort of an easier way of getting at it. Sorry. We also did a sensitivity analysis. I did a sensitivity analysis for this approach. And you can see that over here. Again, if you put in minus 0.1%, so your growth rate's 0.06 instead of 0.16, the value goes up by about 172. If you went with a plus, so you're going to go from 0.16 to 0.26, it goes down about $1.78. You're going to see that you get similar results intuitively. Doesn't matter which of these two we change, we're going to get the same result because it's just one minus the other. So somewhere in the $1.70 to $1.80 range sensitivity on this. So let's just call it 175. Sorry. So again, not very sensitive, not nearly as sensitive as the dividend discount assumptions are. Again, sort of similar to the dividend, to the discount rate. Same result for, not the discount rate, when we do sensitivity for the discount rate, we get a similar result. And things sensitivity-wise are about like the DCF, maybe not quite as sensitive. So, it's just another way that you can do it. It's sort of a shortcut, uses information that you can easily grab. So, how would we reconcile these? Again, the discounted cash flow and the discounted earnings approaches, they're similar. They yield similar results in terms of value growth, sensitivity to errors, discount rate. Really, aside from the fact that one uses the total value of the firm and the other uses value per share, which is basically the stock price. The only real difference is that the discount earnings approach uses net income instead of this free cash flow to equity, and so that's a simplification. It makes it easier to estimate, and in many cases they'll give very similar results. So, what are the issues? Well, obviously, just like with the dividend discount, you can't observe the growth rate or the discount rate. You can see earnings, those are published. You can see analyst estimates of future earnings for the next year, but you still don't know what the earnings for years beyond that are. Also, just from a conceptual standpoint, this net income earnings that we're talking about, it's not actually a cash flow that equity owners are entitled to, not exactly. And so it's a little bit more difficult to make that clean link that says, theoretically these are the cash flows that equity should be looking at. But for a lot of people, when they're just trying to get in a ballpark or compare value between two stocks, earnings per share is the good first approximation. Being completely honest, in the real world, I would say far more people think of valuing stocks using earnings per share than free cash flows to equity or dividend discount. It's a very commonly used model. You'll see when we do comparables how it's used for that. Kind of the insights, again, since it's sort of a compromise between the DCF and dividend discount models, I thought I'd just talk to you about how it works better and worse. It does work better than the DCF model, so a model that uses free cash flows to equity for firms who either do not invest a consistent amount in capital projects each year or do not raise capital in a consistent manner each year. The reason for that is this model, this earnings discount model, the net income doesn't get adjusted for net capital investment or net borrowing, and so it's not sensitive to that. If you are a company that in some years invests a lot of money and in other years invests almost nothing, then your free cash flow to equity from year to year will vary dramatically. And as a result of that, it becomes hard to translate from that free cash flow to equity and your stock price. And becomes hard to build a growth model on that. And we may be seeing that somewhat here. I don't know, with Disney. Same thing if in some years you raise a lot of money, in other from borrowing, let's say, in other years you don't raise hardly any, or you pay out a lot of principal. That's going to cause your free cash flows to equity to move around a lot from year to year. In a way that has nothing to do with the operations of the firm, and so not necessarily ideal. So in this case, earnings are probably going to be a more consistent way of estimating value than the DCF is. Where it doesn't work well is in the instances where companies are manipulating their earnings numbers through accounting techniques. Now, I'm not saying that they're doing anything illegal. I'm not saying that it's not GAAP. But companies have a number of choices of how their final net income numbers appear, depending on certain accounting decisions that they make. And so if they, for example, use those accounting techniques to significantly over or understate earnings in a particular year, for whatever reason, that can lead to some confusion or some questions about how that should relate to the value of the stock. And obviously, so what you're seeing is in one case, if your if your free cash flows to equity are very unstable from year to year, then but your earnings aren't, your net income isn't, then we like net income better. If your net income is very unstable from year to year, but your free cash flows to equity are, then we like that better. So obviously what we like better is the one that's a bit more stable. We assume that stability reflects sort of the true underlying nature of the company on a long-term basis. Similarly, if we look at what we like between the discounted equity model and the discounted dividend model, the one thing we like best is that it works better for firms that, first of all, don't pay a dividend. It also works better even for firms that do pay a dividend if the amount of the dividend that's paid is not really consistent with, let's say, the theoretically correct amount they could afford. So the firm may not be paying out nearly as much in dividends as they should. Perhaps they think they need to hold that money back for investments, or for whatever reason, they're not making good sound decisions about how much they pay out in dividends. Then actually the discounted earnings model might do a better job for them of predicting. Similarly, for companies that will maybe not pay a very big dividend and then all of a sudden pay a dividend, that will make a difference. The other big aspect of that where the discounted earnings works better than discounted dividends is that firms can also pay out to equity. They can give stockholders money back by repurchasing some of their stock from them. So they would go out and take money from the company and use it to buy back a portion of the shares. That both gives cash to the stockholders and takes some stock off the market, which means there's fewer shares out there, so the value goes up. And stock repurchases are not taxable the same way that dividends are taxable. So a lot of companies go to that. Well, the dividend discount model doesn't have a place to reflect that as an alternative, let's just say. And so firms that prefer that method, the dividend discount model is not going to do great. Whereas with the earnings model, an earnings approach, if the stock repurchases are part of a consistent overall plan that just simply says our earnings are only going to grow at a certain rate. We don't need all of the money that we earned this year in order for our investments. We're giving it back. Then you would expect that. Where it does not work well, where the discount earnings model does not work as well as the dividend discount model, is when the earnings are just not very stable. So if the earnings of the company are swinging up and down and positive and negative from year to year, then it becomes very difficult to develop some forward view, or particularly a growth-based view of the equity of a company. Certainly the case if the firm has negative income one year. There's no growth factor you can put on that will make it positive mathematically, and so you can't really use it in those instances. So again, kind of the point here, just another way of that people use to develop estimates of the value of stock. Works better in some cases, not so good in others. Since this is the last one, I'm just going to make this point. What a lot of people will do is develop points of view about the stock, or maybe even work backwards like we did with the growth. They develop these points of view using all three methods, and maybe even some of the others that we'll talk about, and then they sort of triangulate around them. So each of them implies something different about what assumptions you make and so forth. They each result in some value of the stock of the company, and you can imagine that what you would like to see is that those values start to cluster around each other, and it develops sort of a reasonable range for the stock price. And so, that again, we didn't go that way. We were more interested in comparing sort of the growth rates. You can see, though, that what we wound up with is something that says we would expect that the company's earnings, what's implied by their stock price, is that their earnings are probably going to grow at a relatively low rate going forward, on average over their full life. But their dividend's going to grow at a reasonable rate. So those are those are assumptions that you can sort of test whether that's what the market is thinking or not. So that makes it useful. Anyway, that's all on this one.